Welcome to The Explainer. I am so incredibly excited you're here today. If you're a focused learner looking to systematically build your understanding of one of the absolute most powerful tools in finance, well, you're in the exact right place. Today, we're taking a structured journey. Think of it like climbing an escalator of knowledge, focusing entirely on learning the covered call options trading strategy. We're going to start right on the ground floor with basic income generation, and then we'll climb all the way up to mastering complex, expert-level options tactics and even tax strategies.
Now, you might be wondering, what if your stocks actually paid you rent? We all know the traditional buy and hold strategy, right? You buy a great stock, cross your fingers, and just wait. You hope it goes up over the years. But what happens in a sideways market? What if instead of just waiting around, you could act like a landlord? Imagine optimizing your portfolio so your stocks pay you a regular, passive income, literally like collecting rent on a property you already own. That's the exact mindset we're stepping into today.
Okay, let's dive into this. Here's our roadmap for the day. We'll start with covered call strategy basics, then move into selecting the right stocks. From there, we build up to the wheel strategy cycle, followed by managing and rolling options. Then we'll tackle bear market risks and callers, and finally, we reach the expert level, navigating complex options taxes. It's a clear escalator progression from the ground floor basics all the way up to expert-level tax traps. Let's get moving.
Section 1. Covered Call Strategy Basics. Let's transition right into the ground floor of our strategy and introduce the core mechanics of writing options against your own shares.
So what exactly is a covered call? Well, it consists of two main components. First, you own at least 100 shares of an underlying stock. Second, you sell or write a call option against those exact shares. By doing this, you're giving someone else the right, but crucially not the obligation, to buy your stock at a predetermined target price. We call that the strike price, and it has to happen before a specific expiration date. For example, if you own 100 shares of XYZ stock currently trading at $40, you can sell someone the right to buy those shares at $50 next month. They literally pay you cash today for that privilege. And that cash? That's your premium. It requires a pretty major psychological shift, honestly. You are getting paid today to cap your upside potential tomorrow.
Let's look at the two main outcomes at expiration. On one side, if the stock stays below your strike price, the option expires completely worthless. You keep your shares, and you keep that upfront premium cash. Boom! It's the absolute best-case scenario for continuous income. But on the flip side, if the stock rockets past your strike price, your shares get called away. You are essentially forced to sell your 100 shares at that agreed-upon strike price. Sure, you might feel the FOMO of watching a massive stock rally happen without you, but remember, you still keep your premium and you sell at a profit you previously decided you were totally happy with. The key takeaway? You absolutely must be at peace with selling your shares at that strike price.
Section 2. Selecting the right stocks. Moving right up the escalator here, because a covered call is really only as good as the underlying asset you are holding.
Now, what's really interesting about this breakdown is how different stock categories map perfectly to different investor personalities. If you want double dipping, growth plus premium, you look at tech giants like Apple or Microsoft, high liquidity, stable growth. If you're a bit more risk-averse, defensive staples like Coca-Cola or Procter & Gamble offer predictable, safe haven price action. Value-oriented folks might flock to energy and healthcare for long-term cash flow and those nice 3 to 5% dividend yields. But look at that bottom category. High volatility stocks like Tesla. They offer massive premiums because of their high implied volatility. But hear me on this. Do not chase those massive premiums unless you are a highly aggressive trader willing to actively manage the massive assignment risk that comes with it.
Section 3. The wheel strategy cycle. Time to transition to some intermediate tactics. Introducing a really disciplined, cyclical approach to stock accumulation and income. The wheel combines two beginner-friendly strategies to form this incredible continuous income machine. On one side, we have cash-secured puts. This is how you patiently enter a position. You literally get paid a premium just to wait around for a stock to drop to your desired bargain buying price. Then, on the other side, we have the covered calls we've been talking about, renting out the upside of the shares you just acquired for extra cash today. They act as the two halves of one continuous cycle. So here is the step-by-step cycle. First, you sell an out-of-the-money cash-secured put on a stock you actually want to own, collecting a premium. Second, the stock drops, the put is assigned, and you buy the 100 shares at that discount. Third, now that you own those fresh shares, you immediately sell a covered call against them, collecting another premium.
Fourth, the stock rises, your shares get called away, and you're back to cash. And then, the real beauty of this, you seamlessly transition right back to step one. By executing this cycle, you effectively become the casino. You're the one collecting premiums up front at every single stage.
Section 4. Managing and rolling options. Advancing to the next level of our escalator, we need to focus on exactly what to do when the market moves against your initial forecast. Let's talk about rolling. Rolling is essentially a two-part trade, buying to close your current call and selling to open a new one. Here's the vocabulary you need to master. Rolling up means picking a higher strike price but the same expiration. Rolling down is a lower strike, same expiration. Rolling out simply means keeping the same strike but pushing the expiration date further into the future to buy more time. And of course, you can combine them. Rolling up and out for a higher strike and later expiration, or rolling down and out for a lower strike and later expiration.
But here is the absolutely crucial point. Rolling buys you time or adjusts your strike, but it always involves new trade-offs. It's not some magic fix that erases a bad trade. Every time you roll, you're closing one trade and opening another, meaning you're either paying a net debit or receiving a net credit. It's a highly subjective decision to adapt to changing market forecasts. You really have to ask yourself if the new setup actually aligns with your goals. Section 5. Bear market risks and callers. Let's shift the tone a bit here and bust some myths about using this strategy as a bulletproof defense during severe market downturns.
There's a saying in options trading: covered calls are tools, not solutions. And in a bear market, using them as your shield might leave you holding a sword made of glass. Wow, that perfectly highlights the reality that bear markets are for capital preservation, not just squeezing out a few extra bucks in premium collection. And this brilliantly illustrates the compounding risks you face in a downturn. First, limited upside with unlimited downside. You suffer the full brutal loss of the equity dropping, but your recovery is totally capped. Second, the illusion of protection. A small premium does absolutely nothing to offset a 20 to 40% stock collapse. And third, increased assignment risk. If you roll down to chase premiums during a crash and then the market violently rebounds, you get trapped. You get assigned early, locking in those massive losses while the stock recovers without you. To combat this, advanced traders use a collar strategy. This is our expert defensive tactic. It means integrating a protective put alongside your covered call. Yes, you use some of the premium you earn from your call to pay for that put option. But what this does is set a mathematically strict floor under your stock. You cap your upside profit, sure, but you strictly limit your downside risk. It is a true, rock-solid insurance policy for your portfolio.
Section 6. Navigating complex options taxes. We've made it to the final, most advanced step of our journey, the often overlooked IRS realities of frequent options trading.
If you aren't prepared, ordinary income tax rates can severely drag down your actual yield. Short options that are closed or expire are generally taxed at ordinary income rates. Worse, the IRS groups multi-leg strategies under complex straddle rules, which limits your ability to deduct losses before a corresponding gain is recognized. Oh, and listen to this. Getting aside can literally reset the holding period of your underlying stock, wiping out long-term tax rates. This is exactly why a lot of investors prefer running these strategies inside tax-deferred accounts, like IRAs, to completely avoid those immediate drag effects.
However, there's a vital loophole for tax efficiency on unrealized stock gains, the Qualified Covered Call, or QCC. If you write an option with an expiration greater than 30 days and the strike price is not deep in the money, it qualifies. Why is this a game changer? Because QCCs are completely exempt from those restrictive straddle loss deferral rules.
Let's move to the 60-40 rule and see how this builds into one of the most favorable tax treatments in the entire tax code, especially for high-income earners.
This is Section 1256. Broad-based index options utilize the 60-40 rule, meaning 60% of your gain is taxed as long-term capital gains and only 40% as short-term, regardless of how long the trade was actually held. You could hold it for 10 minutes and you still get the discount. This is a massive specific advantage for high-income earners trading market indexes instead of individual equities. Just keep in mind the end-of-year mark-to-market rule, which requires you to recognize unrealized gains or losses on December 31st. We've covered so much ground today. But ultimately, every covered call comes down to one core trade-off. You are selling your future flexibility for cash in your pocket right now. So, looking at your own portfolio and your own risk tolerance, are you ready to cap your upside for the certainty of income today? Think about that as you plan your next move. Thank you so much for joining me on this explainer. Keep learning, keep structuring your knowledge, and I'll catch you next time.